welcome to ICICIdirect. Joining us today, Shailendra Kumar of Narnolia Investment Advisors. As the Union Budget 2022 date is fast approaching, various industry experts are busy forwarding their demands to the Finance Minister, who will present the budget on the 1st of February. Shailendra, it is a tough budget this year, to say the least. The backdrop, of course, is very different. The macro background for this one is different from last year. Last year, we were working with the COVID year and expansive monetary policy, but things are very different now. On the horizon, we have rising current account deficit, the CAD at an 8-year high, a global backdrop of tightening policy, the currency, higher crude prices, inflation, to name just a few. What do you think this budget is going to be all about? Do you think the government will announce a growth-oriented budget or a populist one, especially ahead of state elections?
Yes, Amina, if we look at the context right now, we can't say we are out of COVID. If you look at all the parameters of economic recovery, large part of our economy is still touched by the COVID phenomena, right? And if you look India broadly, you can divide India into two parts right now, One is primarily urban, big industries, people who are on the higher side of the skill set right now. And that India is doing fairly well. In fact, a large amount of growth we are seeing right now in our economy is driven by this one segment of one part of the India, right?
Yeah.
At the same time, the other part of India, which is more a rural consumption story, or a lot of SME, MSME kind of industries. At the same time, those workers who are towards the lower side of the skill set, as well as large part of services growth in economy, that is part of India which is suffering very, very badly because of COVID pandemic background itself, right? So when you say a budget is a populist, it means when the government is trying to push through initiatives more to address the second part of the economy, right? But right now, as the context and the backdrop is, this part is actually suffering. So even as a prudent economist, how you should go about the budget preparation right now, I would say something what is called populist right now is actually needed in terms of economy. That is the right economy right now for the government to do. So I think if you find the after 1st of February, people say this is a populist budget, believe me, that will not be a wrong way to look at the things. This is what is required right now for our economy. That segment requires push. The SME, the MSME, the people with lower skill set. So we require a huge amount of social capex in this economy. Now, at one end, on an old economic paradigm, or maybe if you look at the same thing from a 3-year, 5-year history kind of perspective, you will say populist ICICI budget. But if you truly think, was that the right way to go through? I believe this is the right way to go right now.
Right. Shailendra, very valid point. And that brings me to my next question then. So the budget really, what do you think the focus is going to be? Will the government be more likely to focus on sectors that generate more employment in that sense? Or would it be sectors that are really affected by the pandemic? It is a tightrope to walk, I'd imagine, right?
Correct, Samina. In fact, again, I'll say, those sectors which has got badly impacted by the pandemic is the one which generates most employment. The companies, they are basically capital eaters. So they require more capital, financial capital, not human capital. And all the SME, MSME and the lower startup services industry, they require more human capital. So again, when you come to this question of whether government should focus on pandemic hit sector or where the employment opportunity or employment multiplier will be higher, again, the question boils down to the same principle. You have to focus on the, how SME can be revived, how basically those strata of people who are suffering right now because they're on a lower skill set. So they are not working in a digital kind of a field or a very formally large company. So that's the segment that the government has to focus because that will have the multiplier impact. If you look at it in terms of sectoral, where the highest amount of employment comes from, you have infrastructure as the leading sector, right?
Right.
Both prudent for government capital expenditure and right way of capital expenditure is towards the infrastructure pipeline, which the government is doing already. Plans are already in place. What we need to see, not in the budget, but through the year, we need to see how the implementation goes, right? So that's the part of infrastructure projects kind of. At the same time, I think this budget should have good amount of social capital expenditure on, housing for all has to be given a large push.
Right.
something like education, healthcare, that requires huge amount of impetus, the budget this time.
No, very right. Let's talk about another aspect that gets talked about quite often. Assuming clarity and the pace the government's asset monetization, divestment is something that the market will like to hear on, right?
Correct. Also look at it this way. This year we had a very good tax collection. So tax revenue is very, very good, much better than the what budget expected. And the reason, because this year the amount of growth which has come in our economy has come through the larger company, the formal company. And formal company, they are more better in terms of the government tax collection. They are good for it, right?
Right.
Also, you had a high amount of excise duty on crude and all. Post November last year, now you don't have that window. So in one way, tax collection for the year next will be little lesser in that sense, right? It will not be as buoyant as it was last year.
Mm-hmm.
Compensated. And the next compensation has to happen from the divestment part of it, right?
Right.
This year we had Air India, now LIC IPO hopefully is coming in March. So the good news in that front. But that number needs to be, next financial year, you need to see bigger number from divestment, because your tax collection will be higher. I mean, 13-14% higher surely in the next budget also, next financial year also. But the kind of delta you had this year is not available as economy for the next financial year.
Well, we've talked about the receipts, but let's talk about some spending as well, right? And I want to talk to you about that in a sense of sectors, really. Anything that can be expected that could potentially encourage, for instance, manufacturing in India, PLI, more subsidiary, any other themes that are relevant from a market standpoint, or rather from a listed space, really?
See, if I look at the last 4 or 5 years, the kind of a footprint government has created,
right,
in terms of infrastructure pipeline is very good number, 100 lakh crore plus, over 5 years. So around 20 lakh every financial year. I think in the last 9 months, we had 16 and a half or 17 lakh already done. So we had an excellent plan in place. If you look at the manufacturing, both on the PLI side, your defense manufacturing, look at electronic manufacturing, because the PLI first came to electronic manufacturing some 4 or 5 years back. And the kind of miraculous development and the positive development happened in our economy.
Mm-hmm.
Of course, the other segment like automobile, textile, the chemical, the food processing, it's not much of a matter of policy right now. Policy is already there. The framework is there. We know, in terms of auto, the bid has already come. And hopefully by March, we will have more clarity. What we need to see and track right now is how much of it gets translated in the numbers on the ground, right? So in the pipeline, how the number moves every month in the next financial year. In terms of PLI, now you want more engine to fire. So electronic was firing for the last 3-4 years. Right. Now you see auto component firing, you want to see textile firing, you want to see food processing firing. So those are the kind of initiative we have to look for. And that will be not part of budget, I would say. Allocation is already there. The policies are there. That's more of an executional details that one need to track from here on.
Right. Also, Shailendra, I think boosting consumption, that's relatively crucial as well, right? Anything that could be in the offing to boost consumption? We also talked about the increase of tax benefits for housing loans, because it's been at the same level now for so many years, right? Any other steps that can be taken by the government to boost the economy, to boost consumption? Any sort of significant announcements, even from the salaried class for that matter?
Yes, that will be a bigger expectation from the government this time. The urban consumers who were like working from home, they had made good amount of savings in the last 2 years, because you were not going out to hotel and travel and etc. etc. So you are sitting on a larger savings, and that savings will come in form of consumption whenever the economy opens in a true sense. But where the issue is the second half of India, who hardly had earning on the last 2 years.
Yeah.
Their government requires, the kind of subsidy program they had on food, a lot of, direct employment benefit kind of a thing to that strata of society has to be what has to come into. And you rightly touched upon the mortgage rate. I mean, mortgage, whatever tax advantage you have, has not been changed for many years. And now that requires some kind of a change for sure. Also, in terms of the limit of from where taxation starts, you need to see some kind of a range. I mean, if you look at in terms of how the wages are growing in India, what the level of inflation had been in the last couple of years, that surely requires an upward revision. So that will be a very valid kind of expectation from this budget that we can have.
Right. Shailendra, what could be the factors in that case that could drive the market rally on budget day or even persuade FPIs to pump money back in on budget day?
I would say, Samina, budget and the market will be two different story right now, to my mind. I think this calendar is a big reset. 2022, you are starting with a big reset in the global sense, right? You were living in a kind of a monetary expansion over the last 1 decade. So in US, in Europe, you had a huge amount of monetary stimulus happening. Now we are talking about what? The reduction in QE. Rather, interest rate will go higher in US, in Europe, in India as well, right? As we go. So if you look at it in that sense, 2022 calendar is a big reset in terms of overall, liquidity flow to the market. So that is a more bigger, that will have a more bigger impact on the market than the budget per se, to my mind. And I think there are some good news in that sense when it comes to Indian equity investors. I'll explain you in a little. I'll just take you 2-3 minutes on that. So last decade, if you look at American market in terms of equity performance, has been better than the Indian equity market performance, right? So from Nifty, the S&P 500 of the US has done better. Go and look at precisely why it has happened. So large part of US market outperformance has happened because of corporate buyback happening in the US. All out of about 37% kind of a return that S&P 500 gave in last 10 years, about 140% return came just because of corporate buyback. Now look at the reason why companies were doing huge amount of buyback in developed market. Because they did not had a right amount of fixed income market available to put their retained earning and earn 3-4% because the interest rate was literally zero in those markets. So for a corporation, it was more prudent to buy their own equity from share market instead of putting their money to work in debt market, right? But as we enter into a higher interest rate environment globally, the amount of buyback which we saw in last 1 decade in US will reduce for sure. And that means a little bit of tapering in terms of performance from equity as an asset class in developed market. Now, in India, that engine was not working. We were just growing because of some PE multiple re-rating and some earning growth happened all these years, right? So in a relative sense, our equity performance vis-a-vis developed market will be better from here on because of this reset of 2022, where the world economy from QE is coming to higher interest rate, right? So that will be an India positive event to my mind. And that is nothing to do with our budget. That will be playing out. The story will play out all through the year, I suppose.
Right. Right. Very lastly, Shailendra, we're running out of time, but I'll quickly get one more question in. What do you think the outlook for the markets is? After an exceptional year behind us, there has been some selling coming in. The FOMC also laid out a roadmap that looks far more aggressive than what was initially anticipated. Do you think FIs will remain net sellers in the first half of this year, given the risk of more rate hikes by the Fed, rising inflation, and of course, the way the dollar rupee has been behaving as well?
Yeah, I think that's the most probable scenario right now. In an environment of when the rates will be rising, there will be some outflow from equity as an asset class. India being part of emerging market, whatever outflow happens from emerging market ETF, some outflow will happen from our country also. That's almost a given kind of a thing. But as I said, whether you look at in terms of a structural story driving Indian equity performance, the formalization of economy, the digital content becoming much larger as economic activity worldwide, another all positive which is happening, which we keep talking about, what the India story is working on right now, ensure that the domestic inflow will be very, very robust to my mind. Whatever retail participation has come in the equity market, there's a long way to go. This retail money is investing into cash part of the market, not taking a leverage derivative bet. And that makes the India's own domestic inflow very, very robust throughout the year. Yeah, unlike the last 1.5 years, where we saw a one-way kind of a rally, where every month you had a positive gains from your equity investment, that will not be a story of 2022. You will have a couple of negative months and you will have a good many positive months. So it will be a mix of the market. But net, say for example, for the whole calendar year, we expect a decent double-digit return from Indian equities.
Well, fingers crossed. Thank you, Shailendra. Great talking today on the show. Of course, lots of excitement and anticipation as we count down to the big day. 1st of February, as the finance minister will unveil the budget for the year. Thank you for joining us on the show.
Thanks.
Investments in securities market are subject to market risks. Read all related documents carefully before investing.
Subscribe to our YouTube channel and click on the bell icon to never miss an update from ICICI Direct.